Tom Lee, the Wall Street hype machine, is back at it again. And this time, he's claiming the bull market is going to continue into 2026 yet. According to him, if you're not buying stocks right now, you're going to miss the biggest rally of your life. Now listen, if you're a regular Everything Money viewer, apart from just a thank you for watching, you guys know that I talk about stock market valuation all the time. And I always remind everybody, we don't know what's going to happen in the short run. He very well could be right. Stocks could have a booming year in 2026. But in the long run, if you're banking on buying stocks today at reasonable prices, it's probably not going to happen. And in this video, we are going to break down what if the AI bubble doesn't pop, and what I think stocks might look like in the next 5 or 10 years versus where Tom Lee thinks they might go. So if you're new here, welcome to the only YouTube channel that teaches investing like it's supposed to be taught, with logic and discipline. You are going to hear things here that no one else on YouTube is going to tell you. All right, so let's talk about what Tom Lee is out here predicting. According to him, the S&P 500 is heading to 7,700 by the end of 2026. This is the same guy that predicted the S&P 500 would finish at 7,000 at the end of this year. Tom Lee thinks that now that the Fed is starting to cut rates, that the economy is going to take off, and by the end of next year, we could see a 13% gain on the stock market. I think, personally, and you'll hear me say this till I'm blue in the face, that it is crazy to predict where the market will go in the short run. It's nearly impossible. Now, in some of Tom Lee's recent TV appearances, he doesn't stop at a one-year prediction. He goes ahead and makes a prediction all the way to 2030 and thinks the market is going to go all the way to 15,000 by that date. You heard that right. He's calling for the market to double in the next 4 years. What is that annualized rate of return? That is an increase of 21.7% per year, not including dividends, for the next 4 years. In the last 5 years, we've only done 12.9% without dividends. And we were coming off of an economy that was reeling off of COVID. Now, here's what Tom Lee is saying about his 2030 prediction. He thinks we're heading into a multi-year bull market where companies earn record profits. And guys, that's very possible. As we grow, as the economy grows, profits will grow along with it. And we're coming off of record profits. That means every year we should see even more record profits. But he also thinks the Fed cut or the boost the market over the next 12 months, he thinks that the Fed will keep rates low in the long run, fueling this market to grow further. Lee also sees AI as a new industrial revolution, boosting productivity and making tech half the S&P 500. Yeah, AI is probably going to boost productivity, just like the internet did, just like computers did, just like planes did, just like cars did, just like trains did, just like factories did. All of these things did that, but yet we still seem to grow at pretty similar rates over time. And actually, as we get larger and larger, that growth rate has steadily declined. So put it all together. These booming profits, falling rates, AI growth, and a younger generation of investors getting ready to invest more. And Tom Lee says this is your chance to ride the wave. Buy the S&P 500 now, buy it or miss it. Now guys, when someone says the market's gonna double in 5 years, you need to ask a few simple questions. What has to happen to make that reality? And 2, where are we today that would justify that? Are we coming off of some major economic calamity? Are we coming off a 5 or 10 or 15 year market where the market was really low or bad? No, we're not. We're coming off a booming 5 and 10 year market. Guys, we have valuation levels that are the highest in history, over double where we were in the 2000 tech boom. Guys, I won't make a prediction, but I want to share with you what Warren Buffett calls the single most reliable indicator on where stock market valuations stand at any moment. Now, the stock market to GDP ratio is very simple. It basically says, hey, a country's GDP is what it produces. The companies within that country should grow along with it. And it makes sense, especially the S&P 500. These are the largest companies in the country. Now, there is a shortcoming to it, a very small one that everybody exaggerates. Yes, it might not include the money they make overseas, but I'll get to that shortly. But right now, guys, we are at 127% overvalued. The current ratio is 2.25 and the average is 0.99, so call it 1. We are very overvalued. So what does that mean? Well, guys, the more you pay for something, the less your return. The less you pay for something, the more your return. I hope we can all agree on that one. This phone is a $1,000 phone. If I pay $500 for it, I double my money. If I pay $1,500 for it, I lose 33%. Very simple. Same phone, same everything. The more I pay, the less return I get. Going back 100 years, this data goes back 100 years, the average 10-year return per year is 6.4%, not including dividends. Now, what I did was break this down. I went and looked at it and said, okay, let's go to the undervalued parts all the way to overvalued. When we were 30% or more undervalued, we had 134 quarters in which that data was there. The average return for the next 10 years was 10.7%. How about between 0 and 30% undervalued? Well, we had 227 quarters that matched that. 9% average return. Okay, how about basically even? Or 0 to 30%. We had 134 quarters, 2% return, 30% or more overvalued, negative 1.1%, 40% or more overvalued, negative 2, 50% or more, 2.4, and we're currently at 127%. Guys, if our worst data, 50% or more overvalued, was negative 2.4%, we're at 127. What does that mean for the future? Now, of course, we're all going to sit there and justify, hey, the reason being is AI and blah, 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 blah. Well, guys, I'm going to tell you right now, I think AI is awesome, but the internet was a more transitional change in the economy than AI is. And look at the internet. At the peak of the bubble, we were at high 40% overvaluation. Remember, we're at 127% overvalued today. So we're almost triple the overvaluation. And look at the next 10-year returns. Negative 4.2, negative 4.8%. Guys, it's just math. Now, guys, if you're new here, remember, I'm here to help you understand the markets, the mentality, the psychology of it all. And I'm also trying to help you stay safe from the hype, because the hype is what buries people. The hype is what all that hard work you put in that money to invest, it can destroy years of hard work. Yes, you might miss out on some short-term gains. And right now they feel like permanent gains. But just remember, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. And this is exactly why I teach on YouTube. Because I saw so many people just chasing hype, having these justifications for why things should be more and why things should be less. Now, the good news for you is this. On the upside, people exaggerate. On the downside, they exaggerate. So when things are bad, prices are probably going to go worse than they should be. And I will be on this channel saying, guys, valuations are great. You just need to be patient. Just like now, people in past videos will say, Paul, you've been saying this for years. You're right, I have been saying this for years. And guess what? Eventually it'll come to be true. And at some point when markets are undervalued, people will say, Paul, you've been saying this for years. I know. The question is, do you have the ability to keep the noise out, to avoid the hype, to buy good companies at great prices, and more importantly, to dollar cost average into low cost ETFs no matter what is going on? Look, guys, the truth is that most people are going to lose money with stocks because they don't have a plan. They buy the wrong companies, or, and this is what's more common, they buy the right companies at the wrong price because of hype. They sell it completely the wrong time because of fear. I used to do the exact same thing for years, and it really felt like the market was rigged to take my money. That was until I learned how to invest the right way. This is exactly why we built Everything Money, to help regular people like you stop guessing and start investing with real confidence. You're going to get our stock analyzer, our tools, our courses that teach you step by step. You're finally going to see the stock market through the lens of success, not fear, through the lens of an investor, not a speculator. Try it for 7 days. You'll see. This isn't gambling. It's common sense. Now, guys, as I said earlier, we're not in the business of making predictions on this channel. And honestly, nobody should be. One of the worst things you can do in life and investing is set a bunch of expectations that aren't grounded in reality. Because when those expectations don't get met, you're left frustrated, discouraged, and confused as to what went wrong. That doesn't mean you shouldn't have goals. I love goals. But there's a difference. When you make a goal, you can reverse engineer it. You can lay out the steps, you can do your best, and if you come up a little short, you still made progress and you still built the right habits. And I'm sure that you're better off than when you started. But predictions, they're just noise. They set you up for disappointment in the long run. Guys, look at the Winklevoss twins. They said on November 14th that Bitcoin would never go below 90,000 again. And since then, and as of this writing now, it has dropped below 90,000 3 times. Guys, that's not a criticism of Bitcoin, which I have a litany of criticism of Bitcoin. That's a criticism of predicting short-term market prices. It is impossible. If you said to me, Paul, where do you think the market will be 10 years from now? I would say, listen, I don't know. But what I will say is the next 10 years of returns are going to likely be a lot worse than the last 10 years returns. Why? Because valuations are so high. Are there ways in which it can happen that these valuations make sense? Absolutely. One very simple way: massive inflation. So my question to you is, do you want massive inflation with the stock market going higher? Or do you want reasonable inflation, which means the stock market probably has to correct itself at some point? So here's what I actually want you to do. Control what you can control. You cannot control the Fed. You cannot control the market. You cannot control the news, and you cannot control the next hype cycle. A great statement, I think it was Warren Buffett said, is the stock market doesn't care what price you paid for it. It's going to do what it's going to do. All you can do is control what you can control. Dollar cost averaging into low cost ETFs and buying great companies at great prices. You can control showing up month after month. You can control ignoring the noise. You can stay disciplined. If you do that for the next 30 years, ignoring predictions and tuning out the hype, you're going to look back one day and say, wow, I crushed it. You don't need to be some genius predicting the top or bottom. That's impossible. That isn't what investing is about. What you need is a system. You need a process, a calm, rational plan that works when everyone else is losing their minds. Guys, just start by investing regularly. Don't overthink it. The question I get all the time is, well, Paul, the market's so overvalued. Why should I invest? I shouldn't even say it with that tone. It is a great question. It's a very logical question. But as I always tell people, what you're trying to do is get into a habit that works. And that habit is buying no matter what. Guys, I think stocks are massively overvalued. Only 30% of my net worth is even able to be invested in stocks. I've got real estate, I got businesses, and still, every single month, I dollar cost average into low cost ETFs. Some of those ETFs might be VOO or SPY, which match the S&P 500. Guys, it's the S&P over a long period of time. But this is the price. This is the value. Sometimes you're going to buy high, and sometimes you're going to buy low. But if you're smart and do this, you're going to match the market over times, as opposed to what everybody else does. They buy here and they sell here. And you know what happens to their returns? Instead of getting the market return, they're below it because they buy at the wrong time and they sell at the wrong time. Your job should be to ignore the noise. If they're wrong about the bull market growing from here and a crash comes, that's when you can get more aggressive. And people who are calmer will sit there and say, yeah, we're here right now, but we were here before. It'll go back. But guess what? The news will be telling you why it'll never go back. Just like now, the news, well, maybe as of late it's been different, but before the news was stocks just go up. Look at your friends. Look at your friends' kids. They're all just saying you buy the stuff, it keeps going up. When the market drops, the headlines go crazy and everyone runs for the exits. That's when I need you to stay calm. When stocks are down 30, 40, 50 or more percent, that isn't a reason to panic, as illogical as that sounds. That's the opportunity that we've been waiting for. And if you've built your watch list, if you know what you want to own, that's when you strike. My comment to people is, whenever I see the market at major lows, you know what I hear people saying? Well, Paul, what if the market goes to zero? All the more reason to invest, because if the market goes to zero, guess how much your money's going to be worth anyhow? Zero. The person with the most guns and land's going to win. But guess what? It's no coincidence if you look back at 150 years of stock market history and you chart it out. This is what it did. And if I told you to buy, when would you have wanted to buy? Here, here, and here. Guess what the news was at these 3 points? The world's coming to an end. The economy is going. There was some bad news. And for those of you who like picking individual stocks, this is where real investing begins. Your job is to know the difference. Price versus value. People don't get it. Price is what you pay, value is what you get. All we're trying to do is buy when price is below value. Let me tell you what keeps me sane when the market goes wild. Principles. That's it. Principles are what keep me from getting sucked into the noise. I don't chase hype. I'm not glued to a screen watching price fluctuations. I focus on one thing, gap between price and value, and I let time do the rest. Guys, I'm so dedicated to that. When I log into my brokerage account to sign documents for my bank, I cover up my balance. Because as stocks have been up lately, I don't want to get into this euphoric state of, whenever I buy something, it just goes up. I own 28 companies, and I'm quite sure they're up a lot since I bought them, but not necessarily because of me, because the market's been up a lot. But I don't buy them for the short run. I buy them for the long run. So I buy a company, if I pay a reasonable price for it, and I think 10, 20 years down the road, their earnings are going to grow 4 or 5 times, guess where I think their stock is going to go? 4 or 5 times up. So when prices go up and down like a yo-yo, most people react emotionally. It's understood. We've all been there. They buy high because they're afraid of missing out, and they sell low because they're afraid of losing everything. But that's not investing. That is panic with a brokerage account. Principles stop that, or at least greatly decrease it. Guys, you can't get rid of all your emotion. You're a human. But the principles give you a framework, a logic-based approach that says, hey, I know what this business is worth. And yes, there are going to be ups and downs in profit. But unless the long-term fundamentals change, I'm not changing. That kind of clarity gives you power. It gives you confidence. It keeps you from blowing up your future because you got scared of a headline or two. At Everything Money, we live by 5 core tenets. These are the foundation. This is how we filter out the noise. First off, we are investors, not speculators. Second, every investment is the present value of all the future cash flows it will get. 3, if we don't understand it, we don't buy it. 4, in the short run, the stock market's a voting machine. In the long run, it's a weighing machine. And the 5th, and probably most important one that everyone tends to disagree with, a great story can become a terrible investment if you pay the wrong price. This is the playbook. This isn't sexy, but it works. Now, look, I don't expect you to memorize all of these in one day. That's why I built something for you. A simple, free PDF that lays out all 5 of these tenets in plain English, lays them out, explains them to you. The exact principles I use to greatly decrease the emotional mistakes and stay disciplined, even when the world feels like it's on fire. It's a cheat sheet. It is your guide for staying calm, rational, and focused when everyone else is overreacting. So here's what I want you to do. I want you to click the link in the description. I want you to download the PDF, keep it on your phone, keep it next to your computer. I have it at my desk upstairs and right here. When things get noisy, I pull it out and I remind myself why I'm here, to invest with logic, not emotion. And I want you to do the same thing. We all say we want to do that, but the implementation is hard. But that's why I teach on YouTube. I want to make it easier for everybody to say, this makes sense, let me keep learning. That little document could save you tens of thousands, maybe even hundreds of thousands of dollars over your lifetime. So don't wait. Grab it, read it, and use it. Now, maybe this is the start of the next massive bull run. I have no idea. But if I were a betting man on whether this market has more upside versus downside, I'm going to guess downside, especially on a 5 or 10 year basis. If the market keeps running, great. You have a plan. You're dollar cost averaging. You're buying great companies because even in this market, there are companies selling at good values. But if the market doesn't have a big run, and if it crashes, if reality kicks in, you still win. Repeat, you still win because you're not chasing. You're not guessing. You're using logic and not emotion. And when prices fall, you will understand why prices fall, and it'll make you do something different than everybody else. You want to get to the point where you're buying the market and everybody's like, oh, you're crazy. The market's terrible right now. That's what separates investors from speculators. Stick to your principles. Focus on price versus value. And remember, hype makes the headlines, but discipline builds wealth. If you want to be ready when this market flips, and it will flip, go watch the next video. That's where real opportunity is. So if you've made it this far, that tells me one thing. You're not just here for hype. You're here to learn how to win in the long run when it actually counts. And in this next video, I'm going to show you exactly how disciplined investors can actually build life-changing wealth. These disciplined investors are the ones who ignore the noise and follow the numbers. So click the video on your screen right now. I will see you there. Thank you for your time.